Creativo Solutions. You're currently watching the Finance for Non-Financial Managers video series. If you have any comments or questions, feel free to post them below and consider subscribing to this channel to be the first to find out when new content is uploaded. Visit our website for more content and resources to help you, and follow us on Instagram and Twitter, and keep watching the YouTube channel for more support. Currently, we've covered the financial markets. We've looked at the primary and the secondary market, and we've also discussed what the money market and capital markets are. We've spoken about the efficient market hypothesis in a previous video. When looking at the market, we would assume that all information is priced into the market, meaning the prices that we see in the market are a true reflection of value at that particular moment in time. The efficient market hypothesis assumes that the market is accurate, fair, objective, and honest. To keep the market efficient and to ensure that the market is accurate, fair, objective, and honest, there's an additional level of regulation that will be in place in order to ensure that the market stays free and fair for all the investors. So when focusing on the financial market, there are certain rules and regulations that need to be followed in order to ensure that the market is free and fair for everyone. The regulation and oversight of the financial market is important. It helps to prevent unfair practices from arising. The most recent financial crisis that we've experienced was back in 2008 and 9, where we had what the economists are referring to as the Great Recession. During that time, the financial market experienced a massive drop in prices for many of the assets on the actual exchange, if not all the assets. So when focusing on a financial crisis, we know there are buyers and sellers in the market. And if there are more sellers in the market will fall and prices will drop. So we know that there are various economic cycles that affect the financial markets. If we have a recession, that recession will have an impact on the market going forward. It's important to understand why we have these economic cycles, because they arise from time to time. Markets are cyclical, meaning the market goes through different cycles. We go through stages that are positive in terms of growth and expansion, and we can also go through more negative times where we have recession and decline. So when focusing on a financial crisis, we're looking at those unfair practices that can arise that actually causes the market to collapse. Back in 2008 and 2009, there was a large amount of debt in the market, and there still is currently. But when you have too much debt and you cannot meet those obligations, we know debt is seen as a liability. So if the liabilities exceed the assets, at some point in time, those institutions or those companies go bankrupt. And that's what happened to Lehman Brothers back in 2008 and 9. That particular bank had too many toxic assets on their book, and those assets weren't backed by anything substantial, because debt is a liability, and if consumers are refusing to pay back their loans, you have loans that default, and therefore the bank collapses. And that can be partly due to economic policy, and it could be because of unfair practices in the market, whereby those institutions are looking at trying to make a profit, and they would do that as best as possible in line with the rules, but sometimes they do tend to push those boundaries. And if those boundaries are broken and regulation and rules aren't followed, it then creates an environment whereby people can do what they choose, which can then have a detrimental effect on the market. So we know regulation can be a good thing Some people also view regulation as a bad thing because regulation creates more compliance, and businesses then need to comply and meet all of those rules and regulations, which is costly for most companies. So regulation is good because it tries to protect the market by adding a level of oversight to support the market in order to keep it free and fair. There shouldn't be any manipulation in the market. There shouldn't be any unfair practices being used in order to unfairly profit in a particular market. So when focusing on regulation, we get many different bodies that are going to help encourage good practices. Bodies such as the Security and Exchange Commission in the US, their responsibility is to regulate those companies that are listed on a particular exchange. We also have the FCA, which is the Financial Conduct Authority, and their responsibility is also to ensure that the market is fair. So we need regulation and oversight because it prevents unfair practices from arising. And if we have a market that's fair, we can then trust the market and we can trust the prices of those assets in the market. Regulation is important in order to keep a well-functioning financial market from running. There are other forms of regulation that's applicable to different role players. If we're looking at the financial crisis that occurred in 2008 and 9, the banks were mainly responsible for the downturn in the actual financial market because we had one high-profile bank going bankrupt, and therefore the snowball effect occurred and the market then was further impacted by the consequences of that event. So we know the intermediaries in the market play a very important role. So we have regulations such as Basel III, which is focusing on the international regulatory framework regarding the capital requirements that banks are required to hold in order to keep them liquid. We know liquidity is a factor in all financial management areas, whereby we need to have enough cash on hand in order to meet obligations. So banks are required to have sufficient capital on hand in order to meet their liquidity requirements. So Basel III helps to provide a level of oversight and support in that particular industry to prevent catastrophes from occurring. If banks have sufficient capital on hand, if there are negative market events, because the banks have a level of capital, that should add a level of protection in terms of their efficiency and operational capacity. So being able to continue to operate even when the market isn't doing very well. So regulation is not only about the rules and laws that are applied in a particular industry or across the board in a particular country, but we're also looking at other forms of legislation such as Basel, which helps to regulate the market in order to keep it efficient and to continue operating in the foreseeable future. And that concludes this video. Thank you for watching, and please consider subscribing to the channel. If you have any comments, post them below and consider liking the video, and we'll keep creating more to help you.